So, before we get started, get people in here, I thought I'd open up the mail. We got a piece of mail from Chris, our friend Chris, who likes to send me some coins. So we'll open up the piece of mail here and see what kind of coins he may have sent. All right, we got our first guy up in here. Thank you so much. Be sure and hit the like button when you get into the live stream so we can get as many people aware that we have the live stream going. The thumbs up always help with the algorithm and get things moving. So, Lamont Blanc, thank you so much. Hello. Oh wow, this is quite a big package. So again, this is coming from our friend Chris. Oh my goodness. All right, let's see what Chris has to say here. This is the last one for now, 601. Gas is killing me. Enjoy, Chris. Well, thank you very much, Chris. So it looks like, oh wow, we got a silver quarter, or it's just a quarter proof. Wow, that's pretty cool. Check that out. Focus in there. Well, thank you, Chris. That's awesome. And is this... what is this one? It's like a walking liberty, but... Hey, Matthew, what's happening? No, my birthday was 2 days ago. It was on the 27th. I don't... Oh, wow, what's this? I love Chris's stuff. He always sends me these old coins and old cool things. 24 karat gold plated Trump coin. Haha, right on. Nice one for the collection. Very cool. Let me see if I can get it out of here. There we go. Haha, nice. Very cool. And he's got one more piece in here. Let's check it out. Man, right on, Chris. Thank you so much. Oh. Trying to keep from tearing it open. There we go. Oops. All right. So, what do we have? Whoops. So, little tiny piece of silver. Thank you, Chris. And some really old coins. 1984 Mexican peso. What is that? ZELLE bicentennial quarter, French Polynesian, and a gram of silver. Thank you, man. Those are so cool. Thank you very much for those pieces. Right on. So 168 of you up in here. Right on. Thank you so much for joining the live stream. Be sure and hit the like button. It'll get more people into the live stream. Starts helping out with the algorithm. Whoa, thank you so much, Matthew. Man, right on. Lumberjack Landlord hits me with a huge super chat. Thank you, guys. Thank you very much, Matthew. That is so awesome. Says, thanks for all you do. Happy birthday. Enjoy dinner from the Lumberjack family to the UE family. Well, thank you very much, Lumberjack Landlord. That is very generous of you, man. I really appreciate it. And thank you very much, Chris, for the coins to add to my coin collection. They are very cool. And I really like this Trump one. That's a nice little piece to have for later on in history to show the kids, like, you know, what was going on, and having pieces like that to remember it by is just, it's really cool. So I really appreciate it, guys. Thank you so much. So mortgage rates dropped, huh? Didn't I say that was going to happen in yesterday's video? I said, man, things aren't going to always play out the way you think they might. And I called that yesterday. I said, I don't know if this is going to cause the interest rates on the mortgage rates to go up when you have the Fed funds level just, you know, happen to increase at the same time. And really what I feel it's coming down to is less mortgage-backed securities in the pool for buyers to get at. So essentially the Federal Reserve was a buyer of these mortgage-backed securities, and as they step away from the market, the interest rates began to rise. The free market is essentially the ones who are now playing in the game. Now, I know a lot of people argue with the free market, but let's just kind of pretend for a little bit, if there is one, that's the one who's helping out here as far as keeping a floor under these mortgage-backed securities. Like, they cannot drop any lower than this because at some point there are investors out there who are looking for a fixed income, and those mortgage-backed securities, although were toxic assets at one time, are not the toxic assets they once were, and they are in demand, believe it or not. And so we're finding that there are investors out there looking for fixed income who are willing to buy those mortgage-backed securities at this level. And regardless of the Federal Reserve and their actions with monetary policy, it doesn't necessarily mean that those mortgage-backed security or the mortgages will rise if you have a demand of investors who are willing to put a floor under it like they are right now. Now, of course, a lot of people might argue with, other reasons for this happening, but at least that's what I see, and that's what I was calling out yesterday before this drop in mortgages. What was like almost a half a percent on mortgages fell just today. Hey, all-nighter, man. It's good to see you back in here, man. How was your fishing trip? Obviously, you made it back safely. My birthday was yesterday. Oh, really, man? We have birthdays back to back. Mine's, you were, I guess, the 28th, right? Calling 7 on the dice, right on. So, okay, let's see here. Hit the like button. Any estimate on what the July CPI might be? No, I don't. I mean, if I would have guessed it, I don't think it would have ever gone this high. But then again, like, they still, like, it blows me away. Like, I don't even really follow, like, what the inflation numbers are. I think they're kind of arbitrary anyway. And, they always go back to, like, the highest numbers since, like, 1982 or something like that. And they don't compare it to the way they did in 1982. So it's not even like comparing apples to apples or anything like that. So whatever the number is, it's just the number that they want you to believe. I mean, I think they just construct it to be more psychological than actual, than to be actually factual, Fishing was great. Good to hear, man. We caught our goal over 100,000. Nice, 100,000 pounds. Why did mortgage rates drop? It's probably because the market is pricing in a Fed pivot. I don't think so. I don't think the Federal Reserve is going to pivot at this time. I think they are going to probably keep their Fed funds level on the upward trajectory, at least until they can get somewhat a little bit above the neutral rate, which they're probably at neutral rate right now. So I do feel that they are probably going to continue to raise rates. The time that I think you probably would have to get concerned about it is when you hear the Federal Reserve say that they are going to be data dependent before they make their next announcement on where they're going to go with their interest rates. Like when they take out the forward guidance, that's when I think you should be concerned about like a pivot. Until then, I think they're going to continue to raise rates, especially if they put out the narrative that they're going to do it. Thank you very much, Mateus, for the $4.99. Let's see here. Why the Fed is denying recession? What is it to take to be a recession, right? 2 quarters of negative GDP growth was like a technical recession. But really, what is a recession? I mean, a recession is when you see like mass bankruptcies and foreclosures and unemployment, and we're not seeing any of that yet, right? So when we do see that, then maybe you'll get other people to start recognize it for what it is. But right now, I just don't see, like, it's kind of funny because I'm not trying to agree. Like, I believe in the Fed, right? I'm just trying to look at it the way it is and try to understand how the monetary policy is going to roll after this. But if you were to take, like, what Janet Yellen said, what was it, like 2-3 years ago or whatever, and she said that we doubt we'll ever see another recession in our lifetime. Does anybody remember the last recession? Like, the one that was happening during the pandemic? Like, does anybody even like talk about there being a recession right then? Nobody talks about that. Like, they just papered over it. They just told everybody, stay home, don't make your payment, don't worry about foreclosures, don't worry about bankruptcies, don't worry about unemployment, don't worry about any of this stuff because we're going to paper over all this stuff. And all in the name of like making sure that everybody stays healthy. This was like a complete, it was a farce to save everything, right? If we did not have the pandemic happen and the unusual and exigent circumstance in order to establish the special purpose vehicles, then we would be in a full-blown economic crisis right now. The whole world would be. Not that we're not. I mean, it's just glossed over, it's paper overed right now, but that's essentially where we would be right now. So the Federal Reserve and what they are going to do during the next recession is probably unlike anything that anybody is expecting them to do. Like, typically the Federal Reserve would want to drop interest rates around 5%. but they really don't have the room to do it. So dropping interest rates is not going to really be an effective tool. So what is it that they're going to have? Are they going to have a war? Are they going to have a pandemic? Are they going to have like some, financial market crisis of some sort that they're going to have to come in and try and save? I mean, they need some sort of crisis in order to have the tools that they need in order to combat these downturns in the economy. Like I said, if they didn't have the pandemic, then they would never have had the special purpose vehicles, and they never would have been able to bail out the corporations. And it wasn't them who was bailing it out. It was just the credible threat that they would do it that got the markets to bail them out. Anyway, I don't know. Am I making any sense? Lumber looking good for people that have been waiting to build. Yes, it is. I mean, we hit lumber at what, 525, 540, something like that. We're under 550 per thousand, and here probably, if it depends on how much turnover your lumber yard does. If you have a high turnover rate at the lumber yard that you shop with or work at or whatever, then your retail prices are eventually going to come down. And well, not eventually. I mean, they will come down eventually, but the quickness in which that they do come down really depends on how much rollover you have. Like right now, there's not a lot of building taking place. People are really nervous. But what I'm noticing is a lot more retail customers are coming in, a lot more fence quotes, a lot more deck quotes. People have been delaying a lot of projects because they have been so expensive and trouble finding labor and whatever it is that they've been delaying them. Well, they're now stepping into the game. They're like, okay, well, let's get this thing on. And it's kind of like, I mean, I had kind of come up with this name for it a while back when you have like a gap in people like doing projects, and I just call it project delaying fatigue. Like they're waiting for that best moment to jump in and build that deck package or whatever it is that they're working on. And they just finally get to a point, it was just like, man, I'm just tired of not having it. I'm just going to get in and build this thing. And so I'm done with it so I can enjoy it. And, you think about it, if it's something like a deck, that you're building, like you're replacing one or building a new one, you want that thing done before the end of summer, right? You don't want to build it and then not enjoy it all winter long. You want to enjoy it during the summer. So right now I notice a lot more retail coming into the game. So that, I don't think that's actually going to drive the prices up by any means, but it could get the rolling over of that inventory to happen a little quicker than people might think with the slowing down of building. All right, 400 of you, 476, right on. I'll be out here probably another half an hour or so. Why own bonds long term at 2.6%? I question that myself. Like I don't know if I would really feel comfortable tying my money up for at 2.6% interest, unless I felt that the Federal Reserve was going to go into more monetary easing. If they were to do that, then those bonds that you purchase, even at 2.6%, would start to go up in price, and you'd be able to sell them. So if you wanted to speculate on the Federal Reserve going back into their easing policies, then buying bonds at 2.6%, would make sense if you plan on selling it for a profit later on. And, in the meantime, you can at least get 2.6% on your dollars, which is better than just sitting on it and not having anything at all. So, I mean, I guess there's that, but again, I don't know. Just got 20 ounces of silver. Well, good for you. My mom actually just gave me some silver. She gave me a bunch of silver dimes. It was pretty cool. I'm going to go through them and split them with my sister. Las Vegas 2022. Thank you very much for the $5. Very cool of you. What will this do to housing prices? Well, I think, to be honest, I just really feel that, I mean, in a lot of areas, like my area where it's been like super crazy and ridiculously hot market, I can only say that the prices have got to come down. Like, I mean, they're stupid expensive. But in a lot of areas where it didn't go up like insane like it did here, then I could imagine that you're probably going to see a plateauing of prices where it's not going to increase dramatically like they did. And then in a lot of areas, like I said, you'll probably see where it's going to, I mean, it's got to drop in some areas, especially like places like mine. But for the most part, I would imagine that most of it's going to plateau out, maybe drop some, areas drop a lot. Some places might, I can't imagine anything going up dramatically, but there might be some areas that, have been undervalued that people find that may get some attention while the rest of the housing market is so expensive. But I just don't know if that's really going to be the case for too many places. Most of them are probably going to end up plateauing out or dropping some, and then in hot areas dropping a lot. 10 silver dimes is 1 ounce of silver. Right on. Yeah. Isn't that cool how they, like, another thing, which I thought was weird, is copper pennies, like pre-80, well, 82 is when they switched it over, halfway through 82, or half the mints. But pre-81 pennies and earlier, they're 3.11 grams. 10 of them is exactly 1 troy ounce, which I thought was pretty cool. All right. Midwest prices probably flat. They didn't go up nearly as much as the coast. Yeah, and that's where I'm saying is just like if you look at the housing market as a whole, I can't imagine that it's going to be this huge significant drop. Like Portland, Seattle, Astoria, LA, I don't know, like those places I can imagine where it's just like, you'll find it dropping. Let's see here. House dropping 20,000 and more suddenly right now this week. Finally, curiously. Yeah, I don't know. Like, $20,000 drop on a house doesn't seem like that much when, like, if I was to put my house on the market for what the ZELLE estimate is saying, which I know isn't exactly accurate, but if I was to, I could easily drop it, $40,000 and still gain a hell of a profit off of it. So dropping a house 20,000 when it's been lifted as high as it has, I don't think that. I guess it depends on the price of the house. I mean, if it's a $200,000 house, that might be pretty significant. But when you're talking, $600,000 houses, then 20,000 I don't think is that significant. Thank you very much, Jason, for the $6.99. Hey man, won't they just start cutting rates once recession hits? Inflation appears to have peaked. Oh no, that's the thing. Like I don't know if they're necessarily going to have like the recession fight like they once did. Like I think that fight has already got like bailing out the corporations. Right? That's already been done. Like the special purpose vehicle, dropping of interest rates, the overwhelming demand for corporate debt. Like people just got hungry for this stuff and just loaded up these corporations with tons of cash. And a lot of them are still sitting on that cash. They're not even spending it. Like they didn't buy anything with it. They're just holding on to it. So if we do go into a downturn, it's like a lot of these companies are able to continue to make their payments. Now there is going to be zombie corporations who fail. And I'm not sure if I read this right, but my buddy Tony Lopez, he had like something on his Instagram channel talking about like 20% of companies right now are zombies. Like they are not profitable companies. They operate in the red. And during the great financial crisis, it was something like 8%. Now I'm not sure if that's exactly accurate. I think that's what I read on that page, on his page though. So I mean that could be inaccurate. I don't know. But even if it was, if you were to just take the idea about this, I mean, holy crap, if you got 20% of corporations operating in the red, think about like the mortgage-backed security failure that happened because of all the toxic assets, right? Now, this was people who took out loans who really couldn't afford them, and they took those loans from these people and packaged them up in securities and then sold them off to like retirement funds and insurance companies, pension funds. Everybody bought these mortgage-backed securities because they were a safe asset, a safe fixed income kind of asset that was labeled with a grade A, credit rating or investment grading. Now we have these corporations and the building of what they call collateralized loan obligations. And this is really scary to kind of think about when you think about like a downturn in the economy and the hacking off of the heads of the zombie corporations. These collateralized loan obligations, this is somewhat similar to the toxic assets of the mortgage-backed security markets from back in the great financial crisis. And now these collateralized loan obligations, what these things are consisting of is when a business can't sell their bonds. Like their credit rating is so crappy that they can't even sell their bonds. And what they do is they take out loans from the bank, right? So the bank loans them money and has that loan. So you got like, this asset, so to speak. It's a loan, but it's to a really bad company, right? But you have this loan. So they take those loans and they sell them off to somebody who packages them up, just like the mortgage-backed security. When they take the mortgages from people and they package them up, they take the loans from these companies that are really crappy companies and they package them up into these securities. Now, no one in their right mind would ever buy these damn securities because they're coming from a company that doesn't even have a credit rating that gives them, like, they're below junk bonds. Like, they can't even sell bonds because their credit sucks so bad. But yet they're able to get these loans from these banks, and these banks sell these loans to people who securitize them. Once they're in this security, then they can cut them up what they call tranches, right? So now they're like basically cut up into different levels. And when the companies pay back their loans, not like all of them are going to pay, but most of them pay. So when they pay back their loans, the people at the highest point, highest level, the number one tranche up there, they get paid first. And because they get paid first, and you have like multiple companies bringing in their money to pay back their loans at the same time, they're given a credit rating that is investment grade. Nothing that goes into the security itself has a credit rating or an investment grading that would qualify for insurance or basically pension funds, people who have to have a certain credit rating or investment grading in order to be part of their portfolio. There's nothing inside these securities that would ever achieve that level of grading. But yet, if you put it into a security, cut it up into tranches, and take the highest level and give it that higher credit rating, or I keep saying credit rating, investment rating, now these pension funds can buy into that. So pension funds are buying into these really crappy companies, and they are very well exposed to it. That, we don't know how big that really is. I tried to find that market to try and find out like how much that exposure people have to all that, and I really don't know. But to think of like 20% of companies are operating in the red, I mean, if that's even remotely close, it's just like, holy moly, we could be in for something that just like the financial crisis of 2008 won't even remotely come close to touching what this could be like if all of a sudden bankruptcies of a mass scale start hitting these corporations and these companies, which in turn will take out all these pension funds as well who have invested into these collateralized loan obligations. Woo, that was a long talk. Sorry, guys. Okay, Jaws, right on. $4.99. It's good to see you. What do you think is the most recognized name brand silver produced or buying rounds? Silver producer or buying rounds. Also, have a great weekend. Okay, thank you very much, Jaws. Thank you for the $4.99. So, what is the most recognizable silver? Most likely, it's going to be the American Silver Eagle. I just don't think there's anything else out there that quite is as recognizable as that. However, the Canadian maple leaf is probably a really close one too, right? And then all the government issues to me are really recognizable. Like, those are pieces that you shouldn't have any problems like immediately telling right away if that what it is. So like the anything from the Americas, like the Canadian, the Mexican, the American silver government stuff, um, Philharmonics are really recognizable. But as far as the most, then yeah, I would say it would be the American Silver Eagle. That would be my opinion on it. All right. Should I pay off credit card or pay off vehicle and get title in hand? I would pay off whatever has the highest interest rate to it. Now, my wife was able to get a car loan with a really low interest. Like, it just blows me away. Like, the interest payment on this thing is very low. So we're not too eager to pay it off, although we could quicker if we wanted to. But the credit card, if you got credit card debt, I would hammer that credit card debt. Just hammer that stuff out. That is unproductive debt that you just don't need. And at least with the car, you get to enjoy it. So paying interest on a car, if you're going to justify it at all, that's something you can justify as just like, well, at least I got a ride to drive around and, enjoy. But when you're like making payments on a credit card, it is just like, it's a difficult one to pay because, subconsciously you just like it eat at you because it's just like throwing money away, although it's not. Listening to an investor talk about if you want to get the best return on your money, you pay off debt. There is no better return on money than paying off your debt, because you have to make up, like if you invested as opposed to paying off debt, then your investment has to be above and beyond the interest that you're paying on your debts, which is really difficult with a credit card because they're such high interest loans typically. So paying off your credit cards, paying off debt, by far the best thing you could possibly do, and there's no better way to invest. All right, 600 of you. Thank you very much for being here. Jaws, thank you very much for the $1.99. Mint non-government issued. I want low premium stuff. Okay, Sunshine Mint. That's the one I like to go to. I think that they have probably one of the most recognizable stuff. Uh, I also like Monarch Precious Metals. For one, they're local, so I could literally drive there if I wanted to. But I mean, they're not local, that local. They're within the state here, right? So they're in Oregon. But I like their pieces. They do some really unique, like hand pour looking stuff. They have like some what I like to purchase are these sugar skulls. They're like these Day of the Dead kind of skulls, and I give those out for gifts to people. They love them. They're these little 2 ounce guys, and so they're a lot of fun. So I like Monarch Precious Metals, and they're fairly recognizable. Like a lot of people, when they see that Monarch stuff, they're like, "Oh, hey, right on." You know, they know what it is because of that unique hand pour looking style that they do. Uh, yeah, you're welcome, man. No problem. Thanks for the question. Thanks for the super chat. Let's see here. Okay, UE, keep doing what you are doing. You are providing great information. Well, thank you very much, Fast Sports. I really appreciate that. Hello from Southern Manitoba. I just wanted to remind you that the Canadian Maple Leaf is the best silver round, very recognizable, and no other mint can compare to its security. Thanks. Yeah, and also it's like I think it's one of the only one that actually stamps their stuff with 4 9s, which is like really incredible. American Silver Eagles actually has a little copper. If I got this right, has a little copper mixed into it for to make it more durable, so it's not as soft, I guess. You know, it has more strength to it. But yeah, the American. I mean, I'm a big fan of the Canadian Maple Leafs. I really am. So, what do you think about guys like Warren Buffett, Charlie Munger, and Peter Lynch when they say paying attention to the macro is a waste of time when it comes to your investments? Um, I don't know. I'm really not sure how to answer that because I'm still learning to invest myself, and I find like macroeconomics to be incredibly like intriguing. Like I look at macroeconomics and like I find it to be like one of the greatest puzzles, like the mind puzzles and tricks or games that you could ever possibly be involved with. And a lot of people say, man, with your knowledge, you should be investing and, making tons of money with it. But I really think that investors make terrible economists and economists make terrible investors. And I really kind of see it that way. So I'm not sure, like, if you want to be like a really good investor to study like macroeconomics to the level that I have, because a lot of times you really just kind of have to just take a chance. And when you analyze everything as much as I do, there's like I don't really take chances at stuff. The whole idea of stacking cash while people were screaming inflation was kind of against what anybody would ever think would be investments. Like, they would say, why would you hold on to cash when you know that there's going to be this inflation scenario coming? And it's because, well, I feel that there's going to be a downturn where people are going to unload their assets. They're going to unload gold or silver or cars or stocks or something during the downturns in order to pay off their debts. There's going to be a liquidity crisis coming into the future where there's just simply not enough dollars to pay off all the debts that are out there. And if the Federal Reserve is pulling that money back in, they're pulling in those liabilities, that's going to put some serious pain on people. And when they start feeling pain, they'll start unloading their stuff. Hate to say it, but you buy when there's blood in the streets, right? Love from Idaho. Well, thank you so much. Right back at you. What does 4 9s mean? Oh, four has to do with purity. Yeah, 4 9s. It's stamped 999.9999% pure. Most silver you'll find will be stamped with 3 9s, but Canadian stuff goes up to 4, which is, again, I guess that much more purity to it. UE is wrong. About what part? Stop talking UE. About what? All right. Let's see here. Simon, stop talking, bud. Talking about how inflation is going higher. Talk about how inflation is going. Why would I do that? Why would I say stuff that I just simply just don't believe, right? I do not feel that the monetary policies coming from the Federal Reserve was the reason why we saw so much inflation. I've said it over and over and over again. When everybody was pointing at lumber saying, money printer go burr, prices go up, lumber's all you need to look at. And I said it then when I was at 1,700 per thousand. I said, what are you going to say when it's all the way back down at 500 per thousand again? Here it is. I mean, it's okay if you want to believe that inflation is going to come and destroy you. That's fine. King Dollar is going to come and destroy everybody else, and I'm going to take advantage of that situation. If you don't want to believe it, that's cool, man. Nope, pain, wrong, wrong. What else you got to say, Don? Where are you at here? No blood in the streets. All right, you got anything else, Don? Here we go. You owe me a gold coin. We bet about inflation last year, and he said it would be deflationary mode. I never bet a gold coin. You're crazy. All right, Jeremiah. I gotta stop talking to that dude. Okay, Jeremiah Hampton. Thank you so much for the $5. Do you believe the Fed's forward guidance created the unusual recession with high jobs? They use forward guidance to create a soft landing. Okay, let me see that question again. Do you believe the Fed's forward guidance created the unusual recession with high jobs? Okay, so what created the high jobs was the unusual and exigent circumstances that the Federal Reserve was able to use that they typically would not be able to have in order to create the special purpose vehicle. And then they funded that special purpose vehicle with $650 billion in conjunction with the Treasury. So that situation right there, if the pandemic had not existed, right, if there was no pandemic and we had this downturn, which we were definitely having in the economy, the Federal Reserve would not have had the excuse, the reason, anything that came with it in order to establish that special purpose vehicle. That thing would not have existed. And without that existence of that particular entity, that special purpose vehicle, then they would never have been able to put out that credible threat, the forward guidance, the job owning that they were going to be buying corporate debt. If they did not have that, there is no way that people would have been like, oh yeah, I mean, here we are heading into a downturn. I know what I'll do is I'll buy into a bunch of corporate debt. I mean, nobody in their right mind would have had that even considered that thought. They would have been like, they wouldn't have touched it with a 10-foot pole. But when you have the special purpose vehicle established with $650 billion and you got on the news broadcast every single night about how the Federal Reserve is going to be buying corporate debt, and you got every YouTuber out there screaming about how the Federal Reserve is going to be picking the winners and losers, and everybody is convinced that they're going to be buying into corporate debt, then the corporations get bailed out by the markets all by themselves. The Federal Reserve didn't have to do anything. So did they take advantage of the situation by using forward guidance the entire time? Yeah. That's how they do it. The forward guidance is everything. That's their only tool that they really have, is to try and get the markets to behave in a way that the Federal Reserve can then like get them to go to. If they really thought that a 3/4 of a percentage point was going to damage the economy, then they would have only gone up a half a point. They would have only gone a half a percentage point. But they don't feel that. They know that the markets can handle 3/4 of a percentage point because they put enough information out there to condition the market to be there already. Like if they were to say, okay, we're going to go like 1.5%, like that would flip the markets out, and the markets would definitely start adjusting for this crazy increase in the 1.5%. And then they back off and say, oh, sorry, we're only going to do 0.75%. The markets would flip out about that too. So they can't like just screw with the markets in such fashion. They can't just like all of a sudden just say, well, we can just go up to 1% on the Fed funds level. They really can't. That would cause like a tantrum, right? I mean, they would piss the markets off. So they have to put it out there. This is what we're going to do. Go and condition yourselves for it. When we get there, we'll make it so, and then we'll do some more forward guidance into the future. When they're ready to pivot, they're going to say that. They're going to say we are going to be data dependent on our next meeting on what it is that we're going to do, whether we're going to increase or decrease or stop or whatever it is that they're going to do. If they do not give any forward guidance onto what it is that they plan on doing at the next Fed funds meeting, you know that's the pivot point. That's when they're going to start doing it, and the markets are going to flip out about that as well. They're going to be like, crap, where's our equilibrium? Where do we need to be? Is the Fed lifting? Are they dropping? What is it we need to do? And they'll start figuring out where it is the buyers and sellers need to be positioned in order to deal with that time in the market. And that's really the way I feel. It's like, and the Fed is probably going to try and push those Fed funds rate as high as they can. Like if they could get it to 5%, they would love it. They would just be totally cool to be like, yes, next downturn, no problem. We go back to zero, fire up quantitative easing. We just do the same thing over again. But if they don't get it up to 5%, if they only have it at 3 or 3.5%, what are they going to do? They're going to need some sort of like issue. They're going to need like a war or another pandemic or some sort of crazy financial crisis thing like the housing market crisis or something of that nature. So you know whatever it is, it's going to be bad, or else the Federal Reserve is just going to have to let you sit in a bunch of pain. And that is not politically feasible. Like, I mean, it's just like it would cause people to riot and flip out, and they would be like, the Fed's causing all this pain to us because they're not doing anything about bailing us out, right? So they need something. They need an excuse. That's the problem. They need an excuse. Let's see here. Thank you, Lumberjack Landlord. Man, you just loaded me up today. Thank you so much for the $20. If you had to guess, are rates higher or lower in the next 30 to 60, 90 days? That's going to be questionable. I would watch the 10-year. If the 10-year doesn't move up higher, if it doesn't go back up to like the 3.5% or something like that, then I would imagine that we're probably not going to see major increases to the mortgage rates. And as of right now, I just don't see where there's enough panic in the market to get people to bail out of that 10-year treasury. It seems to be the place that everybody wants to go to. And I don't know, like the next, it's going to be tough. I could see him going up to like, say, bouncing between, where we are now, just over like under 6, like say 5.5 to 7. That would seem like kind of reasonable to me, but I just don't think the Federal Reserve is going to allow it to go any higher than that. That would start freezing up the markets in a sense that people just simply wouldn't want to take out loans. And right now, although it's very difficult for people to make their payments and stuff, it's still not an unreasonably high mortgage rate. So if they could keep it, say, between that 5.5 and 7, keep the housing market from going up, getting too hot, keep it from crashing, and just kind of play that game, then that's where I would say it would be, somewhere between 5.5 and 7. It seems to be where the market is like comfortable enough that it doesn't seem to want to crash the market so far anyhow, and it's not so high that it's unreasonable. I mean, 7% historically is actually a fairly decent rate, but comparatively to the last 10 years, it sucks. All right, what time is it? I got about another 5 minutes, guys. Read the book, The Great, what is it, Despero? I lost your comment. Oh, let's see here. I've been trading the stock market for 4 years. This market is absolutely upside down and normal indices. I'm long on TQQQ and short on DWAC. Thank God my income hasn't changed. If you believe the BLS numbers on inflation and unemployment are accurate, you're either easily duped or a little slow. The Russian patent takeover is hot stuff. Thanks, my friend. Appreciate you. Well, thank you, Matthew, man. Thank you, Lumberjack Landlord. If you guys haven't ever been over to Lumberjack Landlord, go check out his channel. He's got a great channel talking about real estate. Dude's self-built, self-made from the working class, just like most of us have done, and so very inspirational. I like to start getting into the real estate market, and he's inspired me to do so. So I'm hoping to take advantage of that if we do have a major downturn. Great job, brother. Well, thank you very much, Lone Star Texas. I appreciate that. All right, have a few more. Let's see here. UE. If companies expect The Fed will pivot quickly to rate cuts. Could they keep inflation elevated because companies would hold on to their glut of products and wait for better times to sell them? No, they won't. There is absolutely no reasons why a company would ever want to hold on to stuff to try and make more money. That doesn't make any sense because they pay money to hold on to it. It is actually costing them to have inventory, and so there is no reason for them to hold on to it to try and get more dollars out of it, because it's costing them dollars to hold on to it by itself. Everything is about transactions. It's about how much rollover you can get. It's about moving that stuff as quickly as possible. And if you are sitting on that inventory, it is costing you money no matter which way you look at it. So, no, companies will not. I mean, inflation is not caused, again, like everybody is just like kind of stuck on the whole inflation. It's going to be about distribution. If you can get things starting to move through the nation again, like, and that's really where I feel like a lot of these zombie corporations, once these things start to fail, people will start losing their jobs. And when you start losing your jobs, you start going back into service industries, right? So you go from working in an office answering phones to having to do something else, right? Do something where you're working with your hands, you're driving a truck, you're flipping burgers, you're waiting tables, you're doing something that is more of a service type of industry, which has been definitely lagging over the last year or two. So when the zombie corporations begin to fail, and then that decent talent that was at those companies start filling the jobs of the viable corporations out there, the people who ended up with jobs at these corporations who really shouldn't have gotten a job there because really they were just hiring a warm body and not somebody who actually knew what they were doing, those people are going to have to go and do what it is that they can do in order to survive. And that's going to go take some of these jobs out there, these less high status jobs. I'm not sure how to say it, because like I've known quite a few people who have waited tables and tended bar and done stuff like that, and there's a couple of places they worked that they make killer money, a lot more money than I was ever doing working construction or anything like that. So when people like look down upon these jobs, I don't see it that way at all. To me, it's like there's a lot of good money in it, and if you're good at what you do, you can make a lot of it if you anyway, if you pay attention to your customers well. What time is it? 4:42 minutes. Okay, I got like 3 more minutes, guys, and then I'm going to have to bail. Thank you so much, everybody, for being here. 678 of you, 280 likes. You guys are just so awesome. I went candy shopping today, for real. Got a good grade bucket for each family member and stuff it full of their favorites. Right on. If the Fed lets debt roll over, is there actually debt created? If they let it roll over, well, it depends, I guess, if they roll over their, like, okay, so if you're thinking like maybe when a treasury bond matures and they get the money back and then they roll that into another treasury bond, I think probably there would be like an even game being played there if they kept the profit from it, like if they took the interest rate and kept that part of it. But if they took the treasury, the principal from that and the interest rate that came from it and roll that over into a new one, that would be increasing the debt, right? That would be increasing their balance sheet. See, what I think is going to happen is that they may not even get into the market of selling anything. They may just like literally just let it all just mature, like just let the mortgages mature, let the treasuries mature, and then once that money comes back to the Fed, just not buy any more assets with it, just literally to sit on their hands and watch it happen. I mean, that could be a way of letting their balance sheet just unwind all by itself. They don't have to take any action whatsoever. They can just sit and watch it happen. All right. Home building has stopped in Oregon, but renovations over off the hook. Yeah, I do notice a lot of renovations happening, especially, like I said, with the siding projects and deck packages. That seems to be picking up quite a bit. A lot of people are looking for that stuff. Get the luxury bunkers ready. Deflation is the act of deflating. Don, I think you're deflating. All right. If I win the lottery tonight, what should I do? You should buy me a new pickup truck, please. Okay. No one can answer my question. Don, because you're kind of a pain, bro. All right. Reno's happening because lots of retirements. Oh, renovations? Yeah, I can see that, especially in my area. I mean, everybody seems to be retired in my area. All right, how do you think the markets will react in the midterms? I don't know. I'm terrible at predicting what markets do. So, especially when it comes to like stock markets and particular companies and stuff like that. I mean, I'm kind of good at predicting like where lumber markets go. So, like, if you're asking where like lumber markets might be, I might be able to predict that out. All right. All right. I will leave this chat if you can answer my question respectfully. Well, dude, be respectful up here and I might answer it. What is your question? I will buy Yui a new '05 Camry if I win the lottery. Well, that would be cool, man. I'll take a Camry. All right. I love preppers. They hoard for me because they got to sleep sometime. Yeah, that's true. Yeah, be nervous about somebody, sneaking up on somebody when they're sleeping. All right. You got it, bud. What kind of truck? To be honest with you, I don't know, man. I never really even thought about it. I don't know. I don't know what kind of truck I would want. You know? Let's see. Dollar strength UE. Dollar canary trade. Don, where's your question, man? I'm gonna bail out of here. If you want me to answer that thing respectfully, you better answer. Ask me quickly here. Cheers, new pickup truck. Yeah, that would be cool. It would just show up with a brand new pickup. That'd be badass. $10 from Simon Smith. Thank you. You give lots of great videos. Thank you. Okay, respectfully, what goods are cheaper today compared to 2020 since there is no inflation? Well, what good? Okay, I didn't say that there's no inflation. I don't know where that comes from, right? I said that the inflation that you are experiencing has more to do with the supply chain breakdown than it does from monetary policy. So I never said that there was no inflation. I never said that, right? I said that you're going to see the inflation come down once the distribution network opens back up again. Once the mandates came to an end, you saw that the distribution networks immediately started to open up. You are going to find where a lot more products are become more available. Lumber is a very good indicator of that. I mean, if there was inflation, what happened to it in lumber? Like we're sitting at 550 per thousand. Everything else has gone up. I mean, lumber should be at what? Much cheaper than that, right? If there was, or much higher than that if there was, it shouldn't be that cheap if there was a lot of inflation that was going on with it. So it's not the monetary policy that is necessarily causing the inflation. It's not you also have to think like when it comes to the monetary policy, the shot in the arm that we had experienced during the pandemic does cause a lot of prices to go up, especially if you have a supply chain breakdown. So people hoarded up on a bunch of things, paid an exuberant amount of money for this stuff because they felt like it wasn't going to be available to them anymore. And that fear of inflation is a self-fulfilling prophecy that comes into it. Had there not been a supply chain breakdown, I doubt we would have seen the inflation that we had. If everybody had continued to manufacture, if everybody continued to distribute, if the things were not locked up at the ports and locked up on the rails and locked up in inventory someplace and not being distributed because nobody wants to work, and which isn't necessarily the case either, if all that stuff hadn't happened because of the pandemic, I don't think the money printer go burr would have caused anything like what we were experiencing. So really, the supply chain breakdown had a lot to do with this. And yes, when you do give people a shot in the arm, you're going to find prices go up. In the end, it's going to end up being a very deflationary scenario coming from that, because what you have is return on capital investment going negative. So if you have money that you have invested into a fixed income like US Treasuries that pay 2.5% for 10 years, by the time you get that money back, you will have lost purchasing power from that. Even if you were to have low and stable inflation, you would still lose purchasing power from that. So the return on capital investment has gone negative. That is a very deflationary event that's going to happen from the future. What you end up doing is postponing current consumption for past spending. And that's really where the pandemic is going to nail people, is because that was a bunch of current spending. They borrowed money, they got really high on that stuff. Everybody was running around feeling very good off of being high. And then next thing you know, we aren't high anymore. We're incredibly hungover, and now we got to go to work hungover, pissed off because all the money that we make from it has to go to pay for that pandemic partying that we did. That's the type of future that we're coming into. So yeah, I know that the inflation has not come down in the dramatic fashion that everybody was anticipating coming from like something that I guess I had said. I don't remember saying that. What I do remember saying is that all the inflation that you are experiencing has less to do with monetary policy and a lot more to do with the supply chain breakdown. All right, I got to go. Uneducated economist, you let me know.